Hello everyone, this is the second video in beginner series. This is about funding rates and arbitration. So what are funding rates? So typically traditional future contracts like those on SPX, these contracts settle on a monthly or quarterly basis. And at the time of settlement, the contract price converges with the spot price and all open positions expire. But unlike these traditional futures, in crypto we have perpetual futures. These contracts don't have any expiry date, so traders can trade perpetual futures just like spot trading. This is one of the main reason why perpetual future contracts are so popular in crypto community. Now, since these future contracts never expire, so its price can be very different from spot market index price. For an example, if most traders are expecting the price of any asset to rise, they can open positions with more leverage on these future contracts. And when more such positions are opened, then the spread between spot price and the future price increases. Now, to converge these prices of future contracts and spot index price, cryptocurrency exchanges have invented a mechanism which is called as funding fees. So basically, these funding fees are interest rates, the job of which is to converge the price of future contracts and spot prices. Okay, so the funding fee in future trading is calculated on the basis of difference between the spot price and these future prices. This funding fee helps to keep the price of future contracts as close as possible with spot market prices. This fees is paid between trader to trader. Exchanges are not involved in this fee, and funding reset usually happens 3 times every day, every 8 hour. At the mentioned UTC times, you can convert these times to your local time, and you can see uh, at which times funding reset is happening in your country. Also, if uh, the price of any coin is too much volatile on any day, then exchanges can also reset this funding every 4 hour or every 2 hour to converge the prices. Okay, so if majority of traders are long at any moment, then funding rates will be positive, and long traders will have to pay the shorts to balance out the contract once the funding reset happens or the time period expires. So for example, this is the BTC price from today, and it had positive funding. And as we can see here, the countdown is 56 minutes and 4 seconds. That means after 56 minutes and 4 seconds, the long traders will have to pay the short traders a fee of 0.0027%. Similarly, if majority of traders are short at any time, then funding rates will be negative, and short traders will have to pay the longs to balance out the contract once the time period expires or once the funding resets. For example, this is the price of TRB from today. We can see the difference between future and spot prices, and also we can see the funding is highly negative. It's minus 2.5, and it's about to reset in 57 minutes and 1 second. That means after this countdown gets over, then the people who are shorting, they have to pay a fee of 2.5% to long traders. So this is basically when future prices are greater than spot prices. That means positive funding rate. That means long pay funding fee to short. And when spot prices are greater than future prices, then funding is negative, and shorts will have to pay the longs in some way. Now, how these funding rates are calculated? Let me give you an example. For positive fundings, let's take the example of positive fundings first. So for take an example, suppose the funding rate is 1%, and you opened a position with leverage 1x only, and you had a margin of $100. That simply means you have $100 balance in your future account, using which you are going to open a trade, and you are taking a leverage of only 1x. So the position on which the funding is going to be calculated will be your leverage multiplied by margin, that is only $100. So the funding fee deducted will be 1% of your total size, which will be $1 only. So since we are taking the example of positive funding, so short positions will get $1, uh, and long positions will be deducted $1 of the similar sizes of the sizes that are mentioned here. If their position size is same, then they are going to receive and give $1 respectively. Similarly, in second example, suppose funding rate is 1% only, and position is open now with a leverage of 10x, and your margin is still the same $100. So now your position size will be leverage multiplied by margin, that is $1,000. Although you opened a position with only $100, but since your position size is $1,000, so you will be charged funding fee on this $1,000. Since funding rate is 1% only, so you will be charged or receive $10 respectively. Now in both the examples we can see funding rate was same, your margin was same, but as you increase the leverage, so your position size increased, and hence the funding fee will be increased. Similarly, let's take an example of negative funding. For example, we are taking the example of TRB today. Uh, Suppose the funding rate was minus 2%. You opened a position with 1x leverage, you had a margin of $100. Similarly, from the positive case, here also your position size will be leverage multiplied by margin, that is $100. So 2% of that will be deducted for from shorts. So $2 will be deducted from shorts, and long positions of same size will receive $2. Similarly, for the same funding rate, for the same margin, if your leverage is higher, suppose you are opening the position with 10x, then your position size will be 10 times to that, that was at 1x. Now you will be deducted or credited 10 times the funding fee that was deducted or credited with 1x leverage. Now some we can forget when funding reset is happening sometimes. So this is an example of Binance. Binance gives you an option to opt for notification whenever funding reset is about to happen. So you'll get a push notification on your application, as well as you'll get a mail stating the complete details, like how much fee will be deducted, how much percentage fee is going to be deducted, and in dollar amount also how much fee is about to be deducted. So you can use this feature. Now the main question is how we can use this high funding to our advantage. First thing is to trade opposite to market sentiment. It means as when funding is highly negative, like it is happening today for TRB, that basically means there are more shorts in the market than longs. So longs will be paid at funding reset. What you can do is you can place a long order at any good entry whenever you get it, and since funding is very high negative, so market makers will try to squeeze out these shorts by moving the price up till the funding reset. So if you get a good entry at a lower price, then uh, when funding reset is about to happen, then you can move your stop loss in profit just before the funding reset to book both some profit as well as funding fee. Second thing is trading with market sentiment, but the tricky part here is you have to be very precise when you are trading with market sentiment. When funding is highly negative, that means there are more shorts in the market than longs, then usually price will dump just after the funding reset, and it will happen instantly within a second. So before funding reset, you can place a limit stop limit order uh, below the current price. So when price is going to dump little bit to your price, then your short order will be triggered, and then after that you can move your stop loss to break even or profit. But timing is very important for this. Now this is an example of TRB chart from today only. This is a 1 minute chart in which we are going to lead up to the funding reset time. So as we can see, while funding reset is about to happen, price progresses up. Then at the exact time of funding reset, we are going to face a rejection toward downward, and price is then continue moving down. So you can observe this for all the coins with negative, high negative funding on any time frame. But just to show you clearly, I'm showing you here at 1 minute time frame. You can observe this, and then you can take the two strategy trades that I have mentioned with some practice. Now, third thing is arbitrage. What is arbitrage? So when funding is positive, then what you can do is you can buy in spot with half size, and you can sell in futures with the same size. For example, if you have $1,000 in your wallet, then what you can do is you can buy that coin with $500, and with the remaining $500 you can sell in the futures keeping the same size. That means your size should be same. You have to manage your leverage and margin. So after the reset, close both positions simultaneously. Now you won't lose anything from buying and selling, but you'll collect the funding fee. This arbitrage strategy is useful if your position size is bigger. And second way of using this arbitrage trading is when funding fee difference between two exchanges is very high, you can short on one and you can long on another one, and then basically you can close this both position at the same time to get funding fee difference. For example, this is a few days back when perp was pumping, then on OKX its funding was -3, but on Bybit it was -0.67. So we can use this to our advantage here. Now okay, so this is all related to basic understanding of funding fee. I hope you guys understood something related to uh, funding fees and when to avoid it, when to use it, how to use it to your advantage. If you have any doubts, then please let me know in the group. Thank you for watching.